Hello, my name is Sekou Sisi. I am the Managing Director of Epic Tax and Financial Services. I am a certified financial planner and a chartered tax advisor. The Certified Financial Planner certification is the highest professional recognition accorded to members of the Financial Planning Association here in Australia, Canada, the UK, and many other places. The Chartered Tax Advisor accreditations is the highest professional accreditation accorded to tax advisors who are members of the Tax Institute of Australia, the UK, Canada, and many other places. As many of you know, the deadline for lodging your individual income tax return for the year ending 30th of June 2024 is 15th of May 2025. For those of you who have not yet lodged your income tax return, we've put together this video to give you a broad information about how the income tax system works, so that when you contact us to prepare your income tax return, you are not in the dark. This video will discuss the following. Number one, how does the income tax system work? Number two, what are the different types of income taxpayers in an income tax system? Number three, what are tax deductions, and what are some of the conditions you need to satisfy to be able to claim a deduction in your tax return? Number four, we'll talk about some examples of general income tax deductions, and we'll wrap it up by talking about some specialist income tax deductions. So let's get into it. First question, how does an income tax system work? In the case of Australia, we have what is called a universal marginal income tax system. What that means is that the amount of tax you pay is a function of the amount of income you have generated. The higher the amount of income, the more tax you pay. Secondly, you are taxed on your global income, that is income generated here in Australia and in other countries. Income is not broadly defined under the income tax code, but under common law, it includes wages from your employment, interest you receive on your bank account, dividends on your shares, distributions from managed investment schemes and trust, as well as rental income. Now, the mathematics of the tax is fairly simple. You add up the totality of all of those amounts of income, and then if you have expenses to claim against them, you deduct the expense. What you are left with is called your taxable income. And on that taxable income, you pay a rate of tax anywhere between 19 cents in a dollar to 45 cents in a dollar, in addition to the Medicare levy. Broadly speaking, this is how the system works. This brings us to the next question. And that question is, well, what influences the amount of tax you pay? And what are the general categories of taxpayers under the income tax system? So the quantum of tax you pay under income tax law is a function of the following. Number one, the amount of income you've generated. The higher the income, the more tax you pay. Number two, the amount of tax your employer has withheld on your income throughout the whole year under what is called the PAYG withholding system, and we'll talk about that in a minute. Number three, whether or not you are a resident of Australia for tax purposes, or you are not a resident, because if you are not a resident, you do not get the first $18,200, which is tax-free. Now, brings us to the next question. What are the general classes or types of taxpayers we can expect under an income tax system? Broadly speaking, taxpayers will fall into one of the following three categories. The category number one is what we call a deficit taxpayer. Category number two is what we call a balanced taxpayer. Category number three is what you call a surplus taxpayer. Let's go through them. Deficit taxpayer. Who is a deficit taxpayer? You notice that throughout the whole year, if you are working, your employer is withholding tax from your income and sending it to the tax office on a regular basis. At the end of the year, there is a comparison that will be conducted. And what is compared is the following. The amount of tax you are supposed to pay, legally speaking, as calculated using income tax tables, is compared against the amount that you've already paid or pay on your behalf by your employer to the tax office. Such that if what you are supposed to pay to the tax office was $10,000 and your employer only paid $8,000, you have a $2,000 deficit. You will pay that amount when your tax return is lodged to the tax office. The second type of taxpayer is what we call a balanced taxpayer. A balanced taxpayer, on the other hand, is in a situation whereby the amount that is supposed to be paid, legally speaking, exactly equals the amount that was paid on their behalf by their employer. An example, well, the employer paid $10,000 through the PAYG withholding system, and when the mathematics is done at the end of the year, the liability is $10,000. The two balance out, you get nothing back, and you pay nothing to the tax office. The last category is a surplus taxpayer. As the name insinuates, this is a situation where the amount paid on your behalf by your employer is more than what you are supposed to pay under the income tax tables. An example is the employer pays $10,000 via the PAYG withholding system. And at the end of the year, when the numbers are calculated, you are only supposed to pay $8,000. The difference of $2,000 is an automatic refund that you get, and you get that amount even if you did not use a tax agent. Now that brings us to the next question. What is the impact of claiming a deduction in my tax return? Well, the impact is this. You notice that throughout the whole year, when your employer withholds tax from your income, the employer is not aware of the expenses that you can claim in your tax return. So when you claim those expenses, the tax office will give you back an amount equal to the expense you are paying to them multiplied by your income tax rate. For the 2024 financial year, the rate ranges from about 19 cents in the dollar plus Medicare levy to 45 cents in the dollar. So for a taxpayer who is in the 19 cents in the dollar tax bracket, if they claim $1,000 in their tax return, the refund is 190. That's 19 multiplied by 1,000, that's 190. The impact is as follows. If you are a deficit taxpayer, the deficit reduces by $190. If you are a balanced taxpayer, you automatically get $190 refund. If you are a surplus taxpayer, your refund, your original refund increases by another $190. And that brings us to the next question. Well, what is this PAYG withholding system? What is it? Now, the PAYG withholding system, broadly speaking, is a system whereby your employer will calculate tax payable on your income every pay run and deduct that amount and sends it to the Australian Taxation Office. It's called pay as you go. So the amount is calculated every time your pay run is done, and then at the end of every 3 months, some employers on a monthly basis will remit this amount to the tax office, and it will sit with the tax office as a credit, so that when you actually prepare your tax returns, taking into account all of your expenses and the refunds you will get because you are claiming those expenses, then the net result in your tax return is then compared with the available tax credit you have with the tax office. And then once the comparison is done, it may be a surplus taxpayer, deficit taxpayer, or a balanced taxpayer. Okay, So we've talked about that. The next thing that we need to then talk about, let's look at our agenda here. Okay, deductions. The question is, okay, what can you claim in your tax return? Right. You can claim any amount in your tax return that you incur for work purposes. To claim a deduction, it must meet the following conditions. Number one, you pay it yourself and you are not reimbursed for the amount. Number two, it has a nexus to your employment. That is, the employment is the cause of the expense. Number three, the expense is incurred when you are working, not before, not after. For example, if you travel from home to work, that expense is incurred before you actually start working. So therefore, it's not tax deductible. It is incurred too early in the chain. Okay? And the last criteria is that if the totality of the expenses that you want to claim in your tax return is more than 300, you must have documentary evidence that you actually keep in your records. So that's it. Very simple. Any expense you incur that is work related, if the total is more than 300, you keep a receipt. If it's less than 300, you claim it throughout immediately. Some expenses do not require you to have this rigid documentary evidence. We'll go through some common examples of expenses you can actually claim. As I have mentioned previously, the impact of claiming an expense is that you get back an amount that is equal to the expense you are claiming multiplied by your marginal tax rate, and that is via the automatic operation of income tax law. There is no magic in that, right? Where a taxpayer like myself, where a tax agent or tax advisor like myself can actually add value, is spending time with you and talking to you to try and understand the range and the quantum of those deductions that you can potentially claim in your tax return, and assist you get the supporting documents so you can actually claim it, right? But if you already know what they are, it's a matter of plugging it into the system and automatically the result will actually come out. Now, that brings us to the next part of the topic. What are some of the common deductions you can actually claim in your tax return? Number one, we have travel expenses. Travel expenses fall into two categories. This is the use of the car. Either you kept a logbook, and if you kept a logbook, then the amount you can claim is the business portion estimated, the business use of the car estimated via logbook, multiplied by the running cost of the car and depreciation. So for example, if you have $10,000 of travel expenses, this is petrol, registration of the car, insurances, repairs, all of that amount to say about 10,000. And then you have a depreciation of the car, say another 10,000, that's $20,000 altogether. Assuming that you use your car 80% for work, right? Or say if you use the car, say 50% for work, for example, so the total expense is $20,000. They get 50%, multiplied by 20,000, you claim $10,000 of deductions in your tax return. Yeah, it's fairly simple. It's just the business use of the car multiplied by the operating cost of the car. Now, you cannot claim under the logbook method unless you've actually kept a logbook, and you only have to do a logbook once every 5 years. So you do it once and you maintain it for the next 5 years. The law, however, allows you to claim up to 5,000 kilometers without having a logbook. What is required though, if you want to do that, is to have some sort of documentary evidence that substantiate how this 5,000 kilometers was actually arrived at. So for example, an individual who have multiple employers and is traveling between them, from time to time, the average difference between those employers, when you do the calculations, the average difference he's traveling, the average kilometers he's traveling per week, let's say that's the 100 kilometers. 100 multiplied by maybe if you work for 40 weeks in a year, so 100 multiplied by 40, that's 4,000 kilometers. You can automatically claim 4,000 kilometers, and all that is required is a note in your diary to say the distance between my employers is an average of 100 kilometers, and I do that 40 times a year, so 100 multiplied by 40, 4,000. You keep that in your record. That's all that is required for that. Okay, so that we've dealt with the use of the car. You can also claim for uniforms. If you use uniform, now uniform, this is not a uniform. So if you are a professional employee, you use business suits and things like that, you cannot claim it. Uniform has a technical definition. Broadly speaking, it must bear the logo of the bank or be mandatory by the employer before you can actually claim it. Okay. Again, you need to keep a receipt in your records. You don't need a receipt if the totality of all your expenses is less than 300, but the moment you exceed 300, you need a receipt for the entire thing. Okay. Self-education expenses is also tax deductible. With this one here, you have to be reasonably careful, because what we have seen the ATO doing is mandating that you substantiate that the expense was incurred when you are already generating the income. So if the expense precedes the employment, for example, we have cases of international students enroll in a particular subject overseas, come over here and immediately start working in that field upon arrival because they have a previous qualification already. The ATO, unfortunately, in those situations has not allowed the deduction of the claim of the fees in Australia, because number one, they take the view that it is a higher level cost, it's a higher level education, and it's not relevant to the current employment because it was incurred or the commitment precedes the employment. So you have to be careful with that. Okay. You can also claim for home office expenses. If you have home office expenses, they are deductible. Sorry, one of my staff members is self-education expenses. So if the study has a nexus to your employment and it is incurred while you are working within that particular industry and it's a requirement of the job, you can actually claim it. You need to be careful though. HECS expenses are not deductible. So if you're doing a course in Australia and working in the field and you are paying your tuition fees via HECS, that is not a tax deductible expense. If you work from home and you have a home office, you can claim a proportion of the dedicated area you are using for a home office. If you do not have a particular space within your home that you are using for a home office, then the ATO has a specific formula and a rate that can be applied per hour. If we are doing your tax return, we will ask you the relevant questions and we'll be able to actually assist you to make those claims. You can also claim for professional fees. If you are a nurse, you got your nurses association fees. You are an accountant, financial planner, mortgage broker, lawyer, you got professional fees. Those are also tax deductible. Donations to charities is another example. They are tax deductible. Tools and equipment you use for work, they are tax deductible. For example, if you are using your telephone or a laptop that you bought and you use it for work, with both the telephone and the laptop, what you need to do is to ascertain the business use. So if you work out that you use your telephone or your laptop about 50% of the time for work and 50% for personal reasons, then for the laptop 50% of the cost can be depreciated and claimed in your tax return, and for your telephone 50% is also deductible. You only have to do that calculation for a period of 30 days. So you just monitor the use of your telephone or your laptop for a maximum period of 30 days within your financial year and work out a percentage, and you can use that. Okay. Super contributions, we have concessional contributions you can make into super. So if you contribute money to super, you can actually claim that in your tax return. Now that is a very, very special case, because if you want to claim your superannuation contribution in your tax return, you have to make sure that before the tax return is actually lodged with the tax office, you've contacted us to lodge with the tax office something called a notice of deductibility. just basically informing the tax office that you've contributed an amount to superannuation and you wish to actually claim it. That allows you to claim it. If you make the contributions and prepare your tax return and lodge it without submitting a notice of deductibility to the tax office, then unfortunately the amount you've contributed is not tax deductible. Okay, we almost finished. Now that brings us to some specialist type of deductions. So some of the specialist deductions you can claim in your tax return, things like your investment expenses. If you have investment properties, interest expenses, depreciation on those properties at fully tax deductible. If you invest in what is called a forestry managed investment scheme, these are also tax deductible 100%. 100% of your investment into a registered and an approved forestry managed investment scheme under income tax laws are fully tax deductible. Okay. In some cases, you may be living in a particular zone. You might be entitled to a zone tax offset. Okay. That's all today. If you have any questions, please contact us. And I hope this is giving you the sort of information that you need to be able to actually understand the income tax system. As I have said, the deadline for the lodgement of your 2025 income tax return, your 2024 income tax return, is the 15th of May 2025. Let me repeat: the deadline for the lodgement of your tax return for the 2024 financial year is the 15th of May 2025. If you have not lodged your income tax return yet, we'll be sending out an email to our entire database with a list of our tax specialists. You just contact myself or one of the other team members and we can assist you to do that. Thank you very much. I hope that this has been a wonderful education. Please leave a comment.